Hey friends, welcome back to the channel. I'm Iggy, and today's episode is all about being ready for big market moves. Usually we focus on long-term growth and solid investing habits. But right now, something major is making waves through the SGX, and you need to know what's happening if you own Singapore stocks or are thinking about jumping in. Here's what just broke. CGS International has increased their target price for Venture Corporation to $12.14. This is up from several previous analyst forecasts, though it comes with a big asterisk. Despite the price target bump, CGS International, RHB, DBS, and almost every other broker are keeping hold or neutral ratings for Venture. Why? Because the outlook for the rest of 2025 is still labeled as challenging, with growth expected to remain sluggish until at least the next year. Let's look at the latest confirmed numbers for Venture. For the first quarter of 2025, Venture's net profit fell by 7% from the previous year, coming in at 55.9 million Singapore dollars. Revenue dropped 7.5%, totaling $616.6 million compared to $666.7 million a year ago. The company said this was mostly because of lower demand in the lifestyle consumer technology area. They improved their core products with better R&D, but that meant customers didn't need to replace these products as quickly, slowing down fresh sales. Despite these drops, Venture still holds a strong financial foundation. They generated 55.4 million Singapore dollars in net cash for Q1, although it's about half the cash generation from last year's first quarter. They also improved working capital by over 20 million by smarter inventory management. Most importantly, Venture still has no debt, and it's maintaining its 75-cent per share annual dividend. At current prices, the dividend yield is hovering close to 6%, making it attractive for yield-focused investors. So why are analysts not jumping to a buy call? It's all about the bigger trends. The global economy, especially manufacturing, is facing a lot of uncertainty from ongoing US-China tariffs. These tariffs are having ripple effects. About half of Singapore's exports to the US now face a 10% tariff, directly hitting tech and industrial companies like Venture. On top of that, there might be new restrictions coming for products like semiconductors and pharmaceuticals, areas that matter most for Singapore's export engine. According to the Monetary Authority of Singapore, these tariffs act as a kind of tax on Singapore's production and export profits, putting extra strain on already thin margins. Official forecasts for the rest of 2025 show Singapore's GDP expected to grow 0 to 2%, a definite slowdown from the previous year. The Straits Times Index, or STI, hit an all-time high this month, peaking at 4,261 points, driven by strong institutional flows and decent blue-chip earnings. Still, as we speak, the mood has turned more cautious, with most investors pulling back ahead of this week's Monetary Authority of Singapore policy review. There is broad concern that the central bank could halt or even roll back policy tightening to help support economic growth amid these international headwinds. Let's recap 5 crucial points that matter for every SGX investor right now. First, while analysts have lifted Venture's target price, they still keep their ratings neutral. The new consensus target for the stock is between $10 and $14, but with shares trading recently about $12.50, there's limited upside unless we see a sharp turnaround in profits or global tailwinds. Second, Venture's fall in net profit and sales is not an isolated story. Many Singapore-listed tech and manufacturing names are facing the same global weakness. For Venture, the short-term headwind came from customer destocking and muted fresh demand, especially overseas. Analysts suggest that inventory bloating across global peers may be ending, pointing to a slow but positive recovery for Venture into the second half of 2025. Third, trade conflicts and tariffs continue to create uncertainty. The good news for Venture and the broader Singapore economy is that exports, like semiconductors and some high-value electronics, are still mostly tariff-free, but that could change soon. Any new round of US investigations or further trade spats could pose fresh risks. Singapore's government is negotiating to protect key exports, especially medications and AI technology, but the outcome isn't set. Fourth, even with lower earnings, Venture remains committed to shareholder rewards. The company's debt-free stance and disciplined cash management mean it is likely to keep its dividend running. This makes venture appealing for those who want steady payouts, even in rocky years. Fifth, the wider Singapore market is in a holding pattern. The STI is near record territory, but the rally has cooled. Institutional investors have rotated into industrials, technology, and blue chips like venture, DBS, OCBC, and UOB for safety. However, retail investors are cautious, and with an important central bank announcement just days away, short-term volatility could spike if the policy stance surprises. So, what's my read for the everyday investor? Don't panic based on a few weak quarters or scary headlines, but don't pretend that risks have disappeared. Venture still has its strengths: a strong balance sheet, consistent dividends, and a business spread across multiple sectors. The noise around global tariffs and policy changes means we must stay agile. Nothing is set in stone. Review every holding in your SGX portfolio with fresh eyes and understand the why behind each investment. If you want a deeper dive into the charts and my full breakdown of Venture's official reports, join our premium Substack. That's where I post exclusive analytics, updated numbers, and early alerts, so you're never caught flat-footed on market news. Links in the description. And as always, premium members get early access, often a full week before anyone else. That's it for this urgent update. If you find this breakdown helpful, hit that like button, share it with your fellow investors, and subscribe to the Investing Iguana for real-time market reactions and no-nonsense advice.